Before we jump into this episode, a quick reminder that everything said on Bell Curve is a meme and nothing said on Bell Curve is financial advice. Enjoy the app. All right. We're going to be talking about MEV. Miles, want to give us a little synopsis of today's episode?
Yeah, absolutely. So very hot topic, along with the general AppChain thesis is MEV. But I think the two concepts are very interconnected because something we've teased a little bit on other episodes, but the ability to capture more value from MEV, or the ability for applications to recapture some of the MEV that they generate, is one of the big tailwinds of this AppChain thesis. And so, today we'll be speaking to some folks across many different parts of the MEV value chain who operate in general purpose blockchains as well as app chains, to get their perspective on where things are heading and how MEV plays into the AppChain thesis.
Yeah, absolutely. All right. Well, without any further ado, let's just hop right into it. All right, everyone. Welcome back to another episode of Bell Curve. I'm joined, as always, by my co-host, Miles, and we've got Nitesh, Maghnus, and Xavier on to join us to talk about MEV. Welcome, guys.
Great to be here.
Thanks for having us.
Yeah. Excited. So we've got a round robin of folks on the call today, and we're going to be going really deep in the subject of MEV in the Cosmos ecosystem. Maybe just to kick it off, could each of you do a super quick round of intros? If you could just give 30 seconds on who you are and kind of where you are in the MEV space, and maybe I'll just call Nitesh on you since you're first on my screen, then we can go clockwise.
Perfect. Yeah. So I'm the founder of DFlow. It is a protocol for order flow markets. So basically, we're building infrastructure that allows order flow from various sources to trade at sort of a supply-demand market price, and then also build some infrastructure around things like best execution and reputation tracking of market makers.
Excellent. Maghnus, you want to go next?
Sure. Maghnus, I'm a co-founder of Skip Protocol, or Skip.money. We build MEV solutions for Cosmos app chains. Our thesis is around sovereign MEV, so basically providing app chain developers and validators the tools to construct their own MEV markets and customize them to sort of best serve their application.
Yeah, and I'm Xave, so I'm the Chief Investment Officer at Chorus One. So I've been now at Chorus for 2 years, and Chorus One is one of the largest global node operators in the world, i.e. a validator. So we do a lot of work looking into MEV, how it impacts the node operating space. And Chorus One is quite often at the forefront of some of these topics in staking. So we were quite early with liquid staking a few years ago. And we actually released a sort of white paper about Solana MEV last week. So we're always sort of in the weeds and what impacts validators. So yeah, glad to represent the node operating side in the podcast today.
Awesome. So just to kind of kick it off here, I think to frame this episode for listeners, I think we really want to be getting into sort of the nitty-gritty differences of the approaches to MEV in the app space sort of environment as opposed to the generalized layer one sort of environment. But before we do that, with a subject as complicated as MEV and a little esoteric if you're not kind of directly involved with yourself, I think it's good to just sort of set the scene for viewers. Like, what is sort of like the MEV value chain, so to speak, or who are all the major players or actors that are involved in MEV? And Xavier, I know you've done a lot of work on this. Maybe I could kind of kick it over to you. Can you just kind of explain who are sort of the key stakeholders, right, when we talk about MEV?
Yeah, I'll do my best. Mag and Nitesh can chip in here if I've got any parts wrong, because it's not as religious for me as it once was. But so in terms of the chain itself, so a validator like Chorus One would be at the sort of very end. So a validator is the one proposing the block at the end, and everything that happens sort of before the block in terms of like ordering of transactions and everything that goes in the block itself. In the recent past has been sort of modularized in a sense. So in Ethereum right now, they tried sort of separating the difference between the proposer, like us at Chorus One, versus like the builder, the one who's inserting the transactions and building the block to be proposed to Chorus or to a validator. But it goes, even before that, you sort of have a searcher. Sorry, I'm working backwards because I'm a validator, so it might be a bit confusing for people. But yeah, so before the builder, you have searchers. So quite often these are sort of people looking for arbitrage opportunities And then before that, you might have something like a broker, for example, which in this case, in sort of the decentralized finance world, might be like a wallet. And then before the wallet, you have a sort of user creating the transactions. And what's sort of interesting, which we might touch upon in this podcast, is, MEV as a topic, and the value chain of MEV is quite well studied in Ethereum the last 2 or 3 years. And it's the value at stake in Ethereum and the value that sort of impacts users is quite great. Chorus One sort of released some research that as much as like 60% of MEV in Ethereum right now is from front running. Whereas in Cosmos, for example, the users aren't so impacted at the moment because volumes are a bit smaller. But I'm sure Mag and Nitesh can touch a bit more on sort of their specific role and the different types of actors in that MEV value chain in the Cosmos.
Yeah, I can jump in. So I thought that was pretty spot on. Maybe the only thing worth adding there is just that a lot of this does depend on like the ecosystem that you're a part of. So, the value chain is slightly different on Ethereum versus Cosmos versus Solana. And, new ecosystems are popping up too. So, but high level, I think that's, spot on.
Yeah. One thing I would add too, though I thought that was pretty accurate, is that like value chains seem to be very correlated to power dynamics. So like ultimately, for example, on Ethereum, proposers or validators have sort of like the ultimate power over the ordering of blocks. And so necessarily they're paid all the money, right? Whereas like in other ecosystems, there does seem to be a difference in power dynamics, right? So when you come to an app chain world, I think because like the app chain is really built for a specific application, the dev team, right, takes a much more active role, and the community takes a much more active role sort of in the direction of the chain. And therefore that's like sort of disrupted the supply chain in some interesting ways that we've been experiencing and being, has affected our product roadmap significantly. So like, for example, in Cosmos, we've seen, for example, delegators choosing or validators choosing to give more of their money back to delegators versus in Ethereum where it's a no-brainer, you just take it all, right? So there's a big difference there.
Maybe just one thing to add from anyone sort of listening from this from an Ethereum perspective. So one major difference in Cosmos, especially in app chains in Cosmos versus Ethereum, is that, in Cosmos it's delegated proof of stake. So at the end of the day, a lot of these delegators are users themselves and they'll sort of vote with their stake in a sense. So it's a much more complex topic in the Cosmos compared to Ethereum, where there's not so much delegation. So even if you think of Lido, you put one Ethereum in and you get staked ETH, but this is going distributed evenly to all the validators behind that, and you don't really get to choose who your sort of validator is. So it's less important. In the Cosmos, as a validator like Chorus One, MEV is a huge topic for us because it can actually be a way to differentiate and try to capture more stake in a network and earn, voting power from delegators. So, what Mag just mentioned before, what's really interesting, and in fact now Chorus works quite often with Skip through some of these problems, is how different is this in a delegated proof of stake system versus like a pure proof of stake system like Ethereum, where there's a cap and there's not so much delegation and stake doesn't move as much. It's not as free. So yeah, that's quite a big difference in that ecosystem as well.
No, that's great. And I think, we're talking about MEV here because it can be an application's best friend or worst enemy, depending on how it's treated, right? Think about the issues that the economics of MEV can cause is around, potential risks of network centralization, with a few validators really owning all the MEV and getting all of the network stake. And then there's the user side in terms of, users that are getting front run by searchers or sandwiched, right? So we have, this public mempool, which allows this to happen. And, the two of those things can really stymie the entire space, I think. So that's why all these solutions that, folks like yourselves are building have popped up and are really interesting. And so maybe just to talk about what like the perfect world solution would be, I think about it covering three main objectives that it's solving for. It is protecting, mitigating the risk of network centralization, number one. It would protect users from, harmful MEV like front running or sandwiching. And third, it would actually allow the applications that generate the MEV to capture that value and determine, internally how that value should be distributed. And so maybe to get into some of the solutions that are being built right now and thinking about, which of those three or all three they solve for. I kind of bucket it into off-chain solutions, on-chain solutions, and order flow solutions. So maybe I'll kick it to you, Mag. Could you speak to, kind of some of the off-chain and on-chain solutions that you're working on at Skip?
Yeah, sure. So first of all, I sort of agree with those three framing, right? So like reducing centralization, obviously important in decentralized networks. And then also sort of giving chains the ability to express. And then I would say like as part of that, giving chains the ability to differentiate by saying, okay, this is a domain where you don't have front running, right? So like Osmosis was founded sort of as the MEV resistant DEX. So to give them a solution that makes other users front run is probably not going to be in the best interest of them or their users and would be fought against. So like we support two solutions, right? So one is an off-chain builder. We call this Skip Select. It's basically an implementation of a Flashbots-like builder that has a lot more preference expression. So meaning the chain can choose sort of, minimums and maximums in terms of payment. The chain can choose to disable front running and sandwiching by we do that on the ingress side by looking at transaction signing. And then chains can also basically choose, how much of the validator set adopts it, and, validators can sort of make their own decisions about these things. The other side of what we've been building, which we so far have only launched on Osmosis, is a fully on-chain builder. So this actually relates to a lot of the research that's been done by Chorus One in terms of having sort of like side-by-side builders that sit next to the validator that basically build its own block. I just lost a light. Okay, I'm back. So basically what that means is, that the protocol itself will attempt to capture MEV. This is basically like impossible in Ethereum, right? Because you have like generalized transactions. It's like there's so many forms of MEV. Whereas on a place like Osmosis, like what do you have? Swaps, right? And like that's the only thing you really have. And swaps are very backrunnable, right? Like it's very easy to understand how to backrun them. And so when we observed that all the MEV on Osmosis was essentially backrunning, we were like, why can't we just build this like into the chain? I think an interesting design space for us at Skip and where we're moving next is like, how does that generalize? Like, how do you have the properties of an in-protocol builder or an on-chain builder that generalizes to something like auctions? So you can like allow for a searcher ecosystem to also participate.
That's great. And that would actually, the benefits of that is that it leaves the control with the application itself, right? And the application can be ultra opinionated on what type of MEV it allows and how that, value is distributed. Maybe I'll kick it to Nitesh. You were taking a slightly different angle at this with building, I would say, more of an order flow like solution, right? And your primary customers are not chains like Mag, but actually wallets and other sort of applications that basically any app that is not its own execution environment like a DEX. So I'd love to just kind of hear your angle at solving for MEV and which of the dream solution 1 through 3 it is solving for.
Yeah, I think it's difficult to look at this problem and try to come up with solutions without, I guess, trying to identify who the users are that are generating this MEV. At the end of the day, generally this falls into two buckets, like retail and non-retail, so institutional, and that can sort of include, prop trading firms or just anyone who's sort of, a sophisticated model building type, swapper or transaction sender. And so that's sort of where we've started. That's one thing we've looked at when we've, began designing how we approach this problem, is identifying who the users are. And then with that backdrop, we have really positioned ourselves sort of at the application layer rather than the validator layer. So I think a lot of MEV type applications operate really close to the validator layer, and we like to insert ourselves as close to the entities that are actually generating these transactions. And so that ends up being wallets. With that backdrop, basically of one, being able to identify who is sending the transaction, and two, like operating close to the application layer, we get some, really, I think, attractive benefits in terms of the design space. One of those is that we're able to now provide really strong guarantees about MEV to the users who are generating those transactions that cause MEV. And in particular, with retail traders, which is sort of where we specialize, we want to build this infrastructure to be best for retail. We're able to do stuff like give them 100% of atomic MEV for swapping immediately without the transaction ever touching a validator. And this is sort of a really powerful paradigm that I think flips a lot of this, flips a lot of the question upside down. And then sort of that second segment, which is sort of institutional prop, style MEV that gets generated, which it does get generated. If you're a quant trading firm and you're trading on a decentralized exchange, you're still generating MEV, but we don't care about that because, and when I say we, I mean the DFlow protocol, because you're sophisticated. You know how to set up validator nodes yourself. You know how to send transactions in a way which protects your interest. It's just that for that other group, retail, we've basically designed our systems to protect them as much as possible.
Oh, that's really interesting, and I think you're definitely coming in it from the wallet level, which makes the solution a little bit more generalizable to any sort of blockchain architecture. But we've seen, when you're building at the validator level or other parts of the chain, the architecture of the chain really does make a difference in terms of what you can do. And so maybe I'll kick it to Xave, on Solana. This is a general purpose chain. And typically the only solutions we've seen on the general purpose chains have been, off-chain PBS solutions, right? But I thought it was a really interesting piece that Chorus One published, I think it was last week, about potentially moving some of this, to the actual validators themselves on Solana. So I'd love if you could kind of give a perspective there about, maybe these general purpose chains are not limited to just, off-chain solutions or something like a wallet-based solution like DFlow. And yeah, I would love to hear a little bit more about that.
Yeah, no, thanks for bringing it up. So yeah, at Chorus, we were sort of researching this for the last 12 months, and also maybe for listeners who might not be familiar. So Solana is a chain where, of course, there's very, very low fees. And then as a result, especially arbitrageurs really spam the network when there might be an opportunity available for them. And there's, at the time, Flashbots, Jito created a sort of version of Flashbots in Solana. But the way MEV works in general is, so on Ethereum, it's quite even. You have sort of validators now and searchers or builders, and it's quite 50-50. So maybe the validator takes half of the revenue that the searcher would take if there's an opportunity there. In Solana, it's really the other way around, where it's more that a searcher will take almost 100% of an arbitrage opportunity because there's very little competition. There's something like less than 1,000 bots or something like that, and also very low fees. So a validator in Solana will capture very minimal. And at the time, Solana had an ecosystem of quite a lot of volume, which is also something that we might be able to talk about today, like the volume in Cosmos. So the volume in Solana was there, but validators were taking nothing. And I guess at the time, we were quite big in Solana. I think we were the number one node, maybe, or something like that. And we sort of assumed that MEV would become quite a hot topic in Solana. And we decided to research this and sort of build. It's sort of like what Skip has, where it's like in sort of network MEV for Osmosis, but we just decided to do this actually in the validator itself. So essentially, when it's our time to propose a block, we have these algorithms already sort of pre-created and generated, and it'll search for opportunities, just really simple arbitrage opportunities on, Radium or some of these Solana decentralized exchanges. I think a really important point here, though, is that, so we actually open source this and we published the white paper, and you can feel free to check it out on the Chorus One website. It's called Breaking Bots. But an interesting point here is that, in terms of an app chain versus like Solana, which is general purpose. So one thing we talk a lot about at Chorus is sort of searching and building sort of a bit as well, especially when it comes to app specific chains. So in app-specific chains, you have a lot less opportunities, as in everyone sort of knows it's just arbitrage or something that exists in Osmosis, for example. So in a sense, the actual searching is a bit of a commodity, because even like, someone at Chorus who's a researcher could do it themselves. So if you're looking at Solana or Ethereum as general purpose, which means there's a lot more long tail MEV. And by this, I mean, it's not just arbitrage transactions and you're trying to capture extra value by backrunning or front running. There might be some NFT mint, going live on some day, which is huge. And then you sort of want to get your transactions in first, or mint all of them before everyone else and then resell it on the secondary market or something like that. So these are quite clever long tail strategies that exist on Ethereum and Solana. Whereas versus an app chain like Osmosis, which Skip is on right now, it's quite well known the types of strategies that you can use to capture the MEV. So I think it's a really interesting topic, I guess, when it comes to sort of MEV and where the value lies. So we heard from Nitesh that maybe it's at the very start between like users and brokers, for example, which I think is actually super interesting in general. And then you have someone like Skip, which is a slightly more well-known model, which is sort of, but also new in a sense, because they're sort of capturing it for Osmosis itself. So Osmosis, Cosmos, decentralized app chain specific, came out and said that they don't really want bad types of MEV and they don't really want searches. They didn't want malicious MEV in the network, which is quite a bold statement for a network to take. And so they partnered up with Skip, and Skip's done an amazing job sort of neutralizing the MEV almost, where it just captures the most obvious MEV and distributes this back to stakers. And then validators and Skip have a sort of cool option where they can choose the commission on MEV being taken by Skip, sort of. And this is a way someone like Chorus can differentiate. But, sometimes we might run into sort of open questions that we have as a node operator. Because if you think as a validator, we're at the very, very end of the sort of value chain in MEV. And so for us, you could argue that validators, like searching in some networks as well, could also be a commodity. So a question that we always have, any validator will have this question, is how do we differentiate? And clearly a way to differentiate can be through MEV. Why? Because if you distribute back more MEV to your delegators, you're giving them more yield, you're earning more delegations, you're getting more stake. There can be arguments for like, is this a centralizing factor? So I am personally on the fence of like, I think it's really hard to neutralize the sort of centralizing force at any stage of the supply chain. So if you take it away from validators, it's going to move one down. If you take it away from builders, it's going to move one down. If you take it away from brokers, it's going to move one down. So also recently I've seen quite a lot of solutions that are focused on actually returning MEV back to the users, not just sort of so they pay no fees, like maybe a DFlow or some sort of payment for order flow protocol might have, but actually probably like they will earn revenues from like sort of creating the MEV. So I guess what I'm saying here is that I personally think this whole space is really early. Funnily enough, you might argue that like, someone like DFlow, someone like Skip, someone like Chorus is sort of, push and pull with who's capturing the MEV and where it's going and who can do what. And yeah, it's super early, but I think it's one thing about Cosmos as well, like just in general. And, you have a Cosmos Maxi in the podcast, so I hope no one minds if I shill Cosmos a bit. But, one nice thing about Cosmos is that infrastructure, it's really easy to build infrastructure in the Cosmos, which like fundamentally MEV can be a security issue on any network. So I think you're seeing a lot more experimentation and innovation at this sort of infrastructure layer in MEV and Cosmos. So what you're not seeing is volume. Volume is really poor compared to Ethereum. And now we're also talking at Chorus about sort of, there's a lot of building going on in MEV and Cosmos, but now it's about sort of how can we get the volume there? Because you sort of, in a sense, you have to attract some of these searches to your network. And right now, a lot of them is in Ethereum. So a question I'm sure Skip and also, DFlow and maybe some others are sort of asking like, where does this value come from and how can we sort of bring them in? So, I might just quickly mention as well, there's another MEV sort of protocol in the Cosmos not represented in this podcast called Fairblock, which is sort of focused on, mitigating front running in the Cosmos. So then the question there is like, I'm a big personal fan of this solution for this problem. But then the question is this the actual problem in the Cosmos right now? Because there's a lot more flexibility because Skip might already be removing a lot of the front running. So, but then you have something like DYDX, which you also haven't talked about yet, which maybe we might talk about in a second. So DYDX is a network, of course, a lot of volume on Ethereum. This could completely change the game in the Cosmos. Then the question there is, who's going to capture that MEV? And, the order books there are in the validator. So is it the validator that has the control here? Or does someone like Skip come in and maybe they offer to capture it sort of in protocol and distribute it back to stakers in DYDX. So it's really unique how every network will take a different approach, and super interesting as well because you're sort of always on your toes about not knowing what to do next. And that's why we're frequently in conversations with each other about this topic.
Well, that's great. Yeah, and I could not agree more with those points. I mean, I think just how app chains are interesting because the design spaces for MEV is somewhat limited, right, to the application itself. You don't have thousands of apps creating this huge long tail of opportunities. And so, you can internalize some of the MEV that is generated. And maybe Mag, quickly, would love for you to share a little bit about what the ProtoRev module is on Osmosis that will be going live soon. And to me, I think the big difference is that, you are not at the mercy of the validators trying to differentiate, through kicking this back to their delegators. This revenue is actually going to be controlled by the DAO, who can, let it accumulate in their treasury. They can distribute some to stakers. And to me, I feel like this is a big differentiation because it makes this more of a viable business model for apps. And so maybe before going any further, would you just give a quick overview of what the ProtoRev does and how it will benefit Osmosis?
Sure, but also I am in favor of validator differentiation. And so ProtoRev wasn't designed to remove that by any means. So yeah, so basically what ProtoRev is an in-protocol backrunner, right? So similar to what Xave was talking about, like because all you have on Osmosis are swaps, it has the ability in protocol to detect sort of like what the price changes by any individual swap would be, and then to cyclically backrun it right afterwards. So we launched this thing called satellite.skip.money, where you can sort of like see over time. Also, shout out, Chorus One has a great MEV bot on Osmosis you should follow, but it basically records the amount of cyclical arbitrage both do. And we realized it was quite substantial, like $7 million, since Osmosis started. And so basically what it does is it, monitors every single transaction. And then at the execution stage, right, when it's going through the actual processing of the state transitions, it looks and says, oh, wow, like this would move these pool prices this way. Let's arbitrage it back, right? And it does that per every single transaction. So it doesn't insert it as new transactions. It actually happens in the processing of a single transaction. So every single swap you ever do in Osmosis going forward will have like perfectly balanced pools by the end of it. So there won't be arbitrage opportunity afterwards, or maybe there's will be a little bit because we'll miss it, but for the most part, there won't be. I think it's worth noting though that this solution doesn't. This solution is somewhat dependent upon already existing inefficiencies, right? So like when you think about the routing of Osmosis, right? When you think about sort of how, like, why there even is a backrunning opportunity, you could argue, and this is sort of in favor of a DFlow-like solution, that there should be matching, or there should be like built-in backrunning at the front end level, so that it wouldn't make it to like the actual, so like the execution wouldn't create it sort of when it got to the execution stage. I think that's eventually sort of like where we want to start collaborating and thinking about going forward. Because so far, what we've really focused on is, okay, searchers were getting all this revenue. It wasn't even a question of validators getting it or, users getting it. Searchers are getting all of it. How can we distribute it back to the network, since like the network really can do it themselves? And then how do we make that like a governance-driven process where, of course, validators have a say. So I expect validators will receive some compensation for it, but then also, users and individual delegators. But I think like a big focus going forward is really starting to think about the order flow side of MEV in Cosmos and what that looks like.
I want to maybe just kind of bookend this part of the conversation before we move on, but and give listeners like one sort of takeaway, right, for a difference in between like an approach to MEV in like kind of from the ETH framework or mindset, and then from kind of like the full stack app chain mindset. And Maghnus, I kind of heard you say something that stuck out to me at the beginning of this episode, which is, wherever value sort of accrues in the MEV value chain on Ethereum land, it's kind of based on market forces, right? And then there'll be some kind of leverage and push-pull between that different value chain. But one of the differences in like a full stack app chain sort of environment is it's a little bit, to borrow a phrase actually from Miles, is you can have more of an opinion on it, right? And there's kind of a more holistic approach for how do we kind of give some of this MEV back? Do we have an opinion on what sorts of MEV are good MEV and what sorts of MEV are bad? Is that like a relatively okay generalization to make?
I think so, yeah. I think it's like a big part of it is also what Xave said, right? Where it's like validators are, first of all, public and a lot more beholden to their delegators in Cosmos, right? There's only 150 slots. So if you fuck up, right, or you do something that like is evil, then you're going to lose your delegation and it's going to go fast. So I think there's generally a sense of like, okay, the chain founders are saying this is good for the protocol. Like, why would I go against that, right? And sort of like users are saying they want this. Like, why would I go against that? So I think there's definitely more voices at the table versus how I think it is in Ethereum, where I think it's just a different set of power dynamics.
So then I guess I'd like to get maybe just open question to everyone on the call here, but in sort of the perfect solution that Miles laid out, right, where you mitigate risk of centralization, protect users against harmful types of MEV, and then kind of the third one being allowing the application to capture some of the value that's generated from MEV, how would you prioritize? Sort of, let's just say you can't have all three of those things. How do you think those are going to get prioritized? Xave, you look like you got an answer. I'm calling you, man.
I'm not sure I've got an answer because I think there's no answer yet, and it might sound cliche, but it's quite interesting because first of all, it's a very tough question. Which one out of the three you want to prioritize the most? But if you look at Ethereum right now, you can already argue that one of them they're deprioritizing, and that's front running. Like I mentioned earlier in this episode, some ridiculous amount of capital is being taken, quote unquote, from sort of users with no retribution for sort of what they've done or anything like that. So I think networks like Cosmos, for example, clearly this is a major prioritization, especially for Osmosis, which I'm pretty sure right now is the biggest DEX. They've come out and said that we don't want bad MEV, and so they want to avoid front running. And they also want to sort of reduce centralization. You can sort of reduce centralization in a sense, because if validators struggle to differentiate, let's say, it's a bit harder to say like stake with chorus. Okay, you can differentiate with governance and stuff like that as well. But in a sense, potentially it makes the validator game more even because, say chorus 1 is a more advanced validator, we might be able to capture more stake and you might be able to argue this is bad for centralization. So Osmosis here is sort of prioritizing, decentralization and also bad MEV. And also in a sense, it's capturing itself. So I would say they're doing all three. When it comes to like Uniswap or something like that on Ethereum, they're not prioritizing, removing front running because that's just not a thing for them right now. In terms of the actual sort of centralization or decentralization of it, you can't really even compare to Osmosis here, for example, because they're not a chain yet, which I'm pretty sure they will be at some stage, but that's another question and topic. But I think it's hard, and it's like I think another way of thinking about it is it's not just those three things. It's also about how can you keep every actor in the chain happy almost, because someone's gonna like be kicking and screaming if they're not getting enough. And I think that's the beauty of MEV right now, because there's always going to be someone kicking and screaming somewhere. And it's interesting because I could sort of imagine potentially in the future, like maybe even one network goes, we want to use DFlow and Skip. Like that's so cool and also pretty crazy. And you'd never be able to do that on Ethereum, for example. You're sort of restricted to something like just Flashbots. Maybe it's like a fair block and a DFlow and a Skip, and there's like 5 different MEV solutions, and you're like plugging and playing, and then it goes hell modular, and then then it's like then it's a party. So yeah, I think right now it's sort of about preferences of the network, especially in the Cosmos, and Skip, like I think here as well, does a really good job at, it's sort of like a product in a way where they're going out to these networks and asking them, what are your needs and what do you prioritize? Instead of Skip saying like, we prioritize this, or even DFlow, for example, saying we prioritize this, it's going out to DYDX or Osmosis and saying like, what's important for you and how can I build around that? There's a question maybe there of, does that scale? This is a great question and problem to have. And if you can sort of solve this, I think this is a great sort of possibility and potential opportunity for who can do that in the Cosmos.
One quick thing just to add to that is like, I really so just like to dive into one of the points that you said today, which is like, I do think there's going to be two markets, right? There's going to be a market for block space, and then there's going to be a market for order flow, right? And I think like those markets are not like, in my mind, they're not necessarily superior, right? It's like there's going to be markets for, tenants, and there's going to be a market for apartments for them to live in, right? And there's going to have people representing both saying, well, my tenants need this, this, and this. And then people say, well, my apartments are going to require this, this, and this. And I think there's going to be auctions and ways of sort of obtaining both. So if you're a searcher, you're going to need the flow, right, to actually backrun. And then you're also going to need to land it on the chain. So like on both ways, I think you're going to have to participate in both auctions. And so I'm very excited about order flow solutions coming to Cosmos. I think they're a big missing piece.
To add one thing, I think Mag is pretty spot on. Like the right way to think about this is to separate these two, high level markets out into their own distinct things as you try to reason about them. And one of the reasons I think that's like so important is because something that pretty much no one really talks too much about in crypto when it comes to this question of like what are the priorities among those three things is what actually leads to true institutional crypto adoption. And I think right now the number one thing that leads to that is fair infrastructure for liquidity providers. I think liquidity providers, market makers are providing a service to the community, and that service is providing liquidity 24/7. Obviously they're collecting a spread, and if they're a good market maker, they collect more of a spread, but they are providing a service. And in a situation where they have to compete with other takers such as searchers that have like handshake under the table deals with validators, it is impossible for a market maker to profitably make markets and provide that service to the community. So until we get to a point where market makers are able to make markets fairly without getting run over because they don't have some sort of under the table deal, we're not going to see true institutional crypto adoption. And so I think back to Mag's point, which is once we're able to separate these two things out, order flow markets and block space markets, we're able to create, I think, more efficient infrastructure for both parties, both market participants in these two types of markets. So that's what I'm kind of most stoked about in 2023.
Well, that's really, really interesting, especially hitting on the separation there, because I think, no one's really attempted this so far. And so it's hard to kind of visualize what it would feel like for a user at the app level. But maybe just to transition a little bit here, the whole season we've been talking about a spectrum of app chains or app spaces, going from full stack app chains on one end of the spectrum, Ethereum L3s that, settle to a common L2 on the other end of the spectrum, and something like sovereign rollups built on Celestia falling somewhere in the middle. And there's a lot of different flavors there. And so, I think we've talked about today, we've just general purpose L1s and full stack app chains. But in this future that we see is Ethereum and Cosmos on somewhat of a collision course, in that apps on Ethereum will be wanting their own app specific or sector specific rollups. And so I would love to get into kind of what the MEV space looks like for the rollups. Right now there's pretty much no MEV because all these rollups are run by a single sequencer, right? And so I would love to hear, maybe I'll kick it to Mag, because I know you've been working with the Celestia team a little bit. Would love to hear what sort of solutions you were thinking about for rollups in particular, whether these are, coming from shared sequencer networks, and just, how trying to start to tease out just how opinionated, say, a rollup can be about how it treats MEV versus a full stack app chain versus, an app built on a general purpose L1. So yeah, I'll kick it to you, Mac.
Sure, I can take a shot, but I mean, full disclosure, this field I would say is very early. So, I mean, if you think about rollups on a shared DA, right, which I guess you can also put all the L2s and Ethereum in the same category since they, use Ethereum for their DA. There's a question which is sort of like, when do you post the data, right? Like can you coordinate somehow between the different rollups so that you could say like have cross-chain atomicity rules, so that like when you actually have the posting stage, could you sort of combine that together and give traders down at the rollup level some kind of increased preference expression over doing that? One design that I invite anyone watching this to take a look at is Evan Forbes' shared sequencer model. So in this model, basically you have a set of nodes that does sequencing that sit on top of a bunch of rollups, and then they all post their transactions. And the shared sequencer is in charge of basically ordering each one while also sort of extracting MEV and, even doing like cross-domain extraction between them. I think when it comes to like the sovereignty question, we come to this like idea of like fork choice rules, right? So this is the concept that basically like a rollup can decide to selectively choose forks based off of some set of preferences, right? So like, let's say you had 20 sequencers for a specific rollup, and then they all posted a state root, and then they returned back and they each individually said, okay, this is the state that we individually think should be next. The rollup can say, okay, well, that one's based off of front running, that one's based off of sandwiching, and that one I know is good because like they're from, let's say, a trusted sequencer that, follows the rules that I want to. So I'm going to choose that one, and all of you guys just paid for data, but we're not going to include you on chain. So I think in sovereign rollups, you still have the opportunity sort of to have rollups make decisions via fork choice rules about where they want to, how they want to sequence their transactions. I think this space though is very early.
Right. And so it does feel like the value capture there is still at, away from the application or app specific rollup, and more, happening at the actual shared sequencer network level. And I think it just will depend on, how competitive these networks of shared sequencers are, because then, they will actually have to offer, maybe more of that value flowing back to the rollup side. Yeah, so maybe I'll kick it to Xave. Could you speak to a little bit about, what the role of the sequencer is here, and how it differs from, the validator side, and if that's something that you guys are exploring at Chorus One or not?
Yeah, it's a good question. So I have a sort of opinion here on what it could look like in the future, which I think is potentially not thought of so much right now, and it's somewhat related to the work that Chorus has already done on this sort of invalidator MEV. So I've spoken with a few execution layers in the past who have been sort of interested in potentially utilizing, let's say, like a validator that takes all the arbitrage itself, which in this case, a validator is just the sequencer. So you have like the layer 2, here, and then, you have a sequencer here, and the sequencer posts everything back to the layer 1. And quite often in Ethereum right now, there's just one sequencer. And theoretically, it's actually okay to just have one sequencer. It just censorship resistance is a problem here because, it's somewhat reliant on them actually doing the right thing. Even though if they do the wrong thing, you can always prove it. But it's better to, like right now, it's a topic in general of, do you even decentralize these sequences? So even for us at Chorus, like we're not even running any layer 2s right now. So it's so early that we're not even running the layer 2s, let alone thinking of like MEV here. But I think what you could start seeing is this sort of idea of, let's say there's one sequencer, and the sequence, let's say it's an app specific layer 2, and it's just an app. Like Osmosis has a layer 2 on Ethereum, just theoretically. So we all know the opportunities. Skip knows all the opportunities. So in the sequencer itself, almost, you could just have like, working with Skip, sequencer is there, they take all the opportunities, and then X% goes back to token holders, and this is actually what token holders want. And then maybe Skip takes a cut and maybe the sequencer takes a cut. So it's like 10, 10, 80 split. So realistically, what a lot of these applications want is a split of, they just want to return some value back to token holders. And I know on Ethereum right now, this is a massive question. In fact, I feel like every week I'm getting pinged a bit more about like, this is happening in Cosmos or Solana. Like, how can we implement this in Ethereum? So they're becoming a bit more experimental. But I don't think in this really layer 2 MEV space, it's going to be the same as like just a pure builder or something like that. I think if you're just going to have one sequencer right now, then, I think it makes sense, especially if it's app specific. The problem space is less, as I mentioned before. So the opportunities put it in the sequencer. Then there's a question of like, okay, how do you create this deal? And is this deal off chain of like the X% split going to token holders versus validators versus someone like Skip who's doing the sort of building itself? This is another question. Perhaps it's like Osmosis where it's like a DAO vote or something like that. But I do think a major difference here, and Mag sort of mentioned it before, and we haven't mentioned it that much in this podcast, is like the community of the Cosmos is different to the Ethereum community, for example. So if you want to implement a strategy in Cosmos of like 10%, 10%, 80%, you take that to the community and you're going to have a political fight for like a week or two about if you should be 10% or 5% or 1% or whatever. You're just going to be on the forums like all day, all night. In Ethereum, I feel like a lot of it is sort of not under the table, but it's not as obvious. So if there's a protocol app specific layer 2, they want to introduce X% fees, no one's going to really discuss that much or protest against it, let's say. So what I guess I'm saying here is that in Ethereum, you have a bit more leeway, I think, to implement new solutions without pushback from the community because they just want value to their token, a lot of Ethereum token holders and layer 2s. In Cosmos, it's this ethos of like, we really want many chains, and the community has a loud voice, and then validators have to listen to their delegators, as we mentioned at the start as well, because delegated proof of stake. So it's harder to sort of manage all the parties there, I guess is what I'm saying. So it's super early, it's sort of confusing response, but I do think one takeaway here is that it will look a lot different in Ethereum versus Cosmos, and it's like when Celestia is out and layer 2s are sort of arrive in Cosmos this year.
I think that totally makes sense, and it's pretty easy to get excited about some of these solutions when you can part of the benefits is that all of this value that was being captured by only one party is now being recaptured by the application, right, and then sent to users. Maybe for Nitesh, because you are taking a different angle here, could you speak to, I guess, some of the benefits that users will see, even if they have no idea that they are sending order flow, through DFlow, and what the value prop is there for wallets on behalf of their users?
Yeah, I think the biggest value prop is that these wallets who want to provide a good user experience for their users and also monetize without necessarily, slapping fees onto the order flow. The benefit there is that they have a really simple mental model for how they should think about order flow monetization with DFlow, because we abstract away the actual infrastructure where transactions go and settle. To us, any blockchain is identical because we have isolated common properties of each one and just interface with that interface that we define. So for wallets, that's probably the best benefit. Obviously, this system is, it has a trade-off, which is that we can only reason about a certain transaction type. It just so happens to be that the transaction type that we reason about and that we specialize is market orders from retail traders, which is also like, 99% of all transactions that have MEV. So I think we solve the problem. We don't aim to be a general purpose solution, but we are specializing on a class, which is pretty much the entire category. And so for wallets, it's, it becomes really simple with a solution like DFlow.
That's great. And I think, we've touched on it a couple times here. But if we are moving to this app-specific world, app-specific chain world, either app-specific rollups or, these sovereign rollups or full-stack app chains, there's going to be a need for these cross-chain MEV solutions. And so we've learned a little bit about what Flashbots is building with Suave, and some similar ideas have been introduced on the Cosmos side, first in the Atom 2.0 paper with the interchain scheduler. But yeah, I would love to kick it to Mag again here to talk about, what is the purpose of something like a cross-chain, priority block space marketplace? What are some of the use cases that can be solved for the applications that cannot be solved with these intra-chain solutions, and kind of teasing out, I guess, where this side of the space is going?
Yeah, definitely. So cross-chain MEV is very complex. I think it's like something that is easy to understand conceptually, but when it comes down to actual implementation, quickly becomes almost seemingly impossible. At least on Cosmos, where you have like a bunch of separate L1s that don't have any communication like baseline except for asynchronicity. So basically, there's no way to coordinate like, okay, you do that, and then I'll do this. Like you can't say that, right, atomically. Whereas in some place like, Intrachain, or let's say on Ethereum, you have that kind of composability. You can say, do this, then this, then this. Otherwise, don't do any of it at all, right? And that's what we call like atomicity. And it's as simple as like a transaction in Cosmos. You can have multiple messages, right? One might be a swap, one might be a flash loan. And so you have that natively, which enables a lot of this MEV that looks like arbitrage, right? So if you don't have that, right, like how do you even start to reason about like MEV? So like the simple answer is, okay, I can keep a lot of money here and a lot of money here, and then, sorry about that, I can basically arbitrage between them by taking swaps on either side, right? Another way I think you can think about it is you can sort of like go more of like this suave, and then don't want to butcher DFlow, but I think they're thinking about it this way, which is like some sort of general cross-chain market making, right? Where you can like aggregate the order flow and then give it to market makers, and then they can do the cross-chain MEV in a way that's actually good for the ecosystem, like arbitrage in a good way. I'd say, so like in terms of solutions that I've seen for cross-chain MEV that like potentially really would work, the scheduler is one, but it's quite a bulky solution because you have to like, you have to buy the right to be the proposer in multiple different chains over a synchronous period of time. So it's like, what if I just want one transaction? Like, why do I have to buy the right to build everything? And then also sort of like these preference matching solutions. So like Suave, I think the shared sequencer, and then, anything that sort of deals with like cross-chain order flow. I would say like one other thing to note is that I think generally most cross-domain MEV is not really between chains. It's mostly between decentralized exchanges and Binance or centralized exchanges. And I think like one thing that we've discovered over time coming in very excited about cross-chain MEV is like, wow, this is not really happening because the price discovery is all happening on the deepest liquidity pool of them all, which is the centralized exchange. And so I think in the short run, the way these play out in my mind is there's going to be a lot of sort of like sex to dex arbitrage tools versus sort of like dex to dex, given sort of the complexity of that, as well as the fact that it's just not where prices are being discovered, right? Yeah, I'll say that much.
I don't know if anyone has any response to that, but I want to kind of conclude actually with sort of a discussion of even within sort of the cause. So I want to talk a little bit. I mean, there's a lot of discussion in MEV around kind of like Xave got a lot of really great points from kind of the validator perspective on this call, but I'd love to talk a little bit about kind of the role of middleware and maybe specifically wallets. So like one sort of metaphor or idea that we've sort of drawn on kind of time and time again throughout this series, this idea of like the proximity to the user is ultimately extremely, extremely important in terms of leverage, right, over an entire value chain. And if the ultimate like kind of capture or lock-in for the user ends up being at the wallet layer, you could see them having an enormous amount of control when it comes to MEV, and maybe even dictating, right, what makes good MEV versus bad MEV, which is kind of an interesting philosophical discussion in and of itself. So maybe Nitesh, we kind of call on you, like, I mean, is there kind of some future state, right, where there's like a wallet super app, right, which ends up having like an enormous amount of sort of control? I'd just love to get your sort of thoughts on that.
Yeah, there is definitely a future state where, maybe a single wallet or a handful of wallets have so much user activity that they sort of dictate ecosystems. And it's a really dangerous path for crypto because of that power, yielded to some centralized group of people that operate these wallets. And I think really the only solution to this is creating economic incentives that basically prioritize the decentralization of order flow over the centralized distribution of order flow, which is, I mean, coincident in the name of DFlow. That's kind of what we try to do, is create economic structures that decentralize order flow. but really, this is quite a big problem, and creating these economic incentives is definitely, I think, the number one priority of infrastructure projects in crypto, or at least it should be. Happy to talk about how I see that playing out, but wanted to pass it on to anyone else who has thoughts as well.
Yeah, I would love to get everyone's thoughts, because even to maybe just compound, Nitesh, on what you're saying for like how this might be able to play out, it's like one of the dynamics that's made this so difficult in Web 2 to kind of point at, kind of our Web 2 giants and say, hey, what you're doing is anti-competitive or not good, is because they keep doing things that are ostensibly good for the customer, right? Like if you take a look at like one of the super apps being like Amazon, right? They do things that are very good for the consumer, right? Like you can return anything on Amazon with, or for a while you can do this, right? No pictures, no anything. But who's getting squeezed on the other side of that is kind of their network of vendors, right? That have these really strenuous sorts of terms, and they're exerting their enormous leverage kind of down the chain. And you could see a similar dynamic there happening with MEV. So I don't know, Mag or Xave, if either of you guys have thoughts on this, or if you just want to close with like a philosophical discussion of like what is good MEV versus bad MEV. I'm sure you guys both have thought about that quite a bit.
Maybe just before we move on to that topic, I just have a quick point on the wallet side. And it's sort of, when you think about the chain here again, so, at the start it was miners and they were capturing all the MEV. Then, then the builders and searchers came in, they were capturing the majority of MEV. And then now it's like pushing down again, and maybe it's like the wallets that end up being the ones that are centralizing force, and they're capturing the MEV. And it's like, at what stage of the chain or what new, like at somewhere it's going to get clogged up, I guess. So I do really like DFlow's solution. And actually I was going to mention as well, back to Mag's point before, on this like cross-domain MEV. So here potentially is like where even a DFlow or something like that could integrate like cross chains maybe, and like maybe this is sort of the way. Like, and that's how it works in Cosmos, and maybe Skip specializes in just like a chain by chain sort of basis, and they sort of work together. So yeah, again here, I think just super early and really interesting. And then maybe to close on the good versus bad MEV, I think, the fact is Cosmos is about choice, and, all networks have the choice and sovereignty to choose if they want bad MEV or good MEV, or if it's a topic at all. And this is the beauty of the Cosmos in general.
Oh, sorry, go ahead.
Yeah, sorry, I was just going to make a quick point on what Michael and Xave just said, which is I think it's really important to note that in this future state where these wallets have been yielded so much power, it's important to understand with the Amazon comment that what they're doing is not an effort of trying to be nefarious. It's an effort of trying to give their users the best experience. It just so happens that right now, the way things exist today, the best experience for users is to, under the table, sell their order flow to some centralized thing, which will guarantee like great execution, but is also a centralizing force. So I think, that's maybe one of the big things that we're trying to work on, is just how do we get something that's better for users UX than like a really tight knit but ultimately centralizing under the table deal with some quant market maker or something like that.
Nitesh, sorry, go ahead, Mike.
That specific example is a really interesting one, by the way, because even if let's just give Amazon the benefit of the doubt and say the reason they do that is to protect the interests of their users, their customers. It ends up kind of very indirectly not being good for customers, though, because what ends up happening is in this like terms of service, right? If you're a merchant that signs up with Amazon, the price that you sell on Amazon cannot be different from the price that you quote anywhere else. And what the retailers say is, well, I don't want to give up 30% of my margin. Sometimes that's more than their entire margin. So what they do is they just mark everything up so that they can sell on Amazon. And they had the same margin as before, but now they're selling on Amazon. So basically what you've just done is you've marked up the entire intranet. And then even though these users think that they're getting a deal, actually nobody's getting a deal, and it's just more expensive everywhere. So just like, it's a funny example of how even if they are doing this supposedly for the right reasons, you kind of still end up screwing people too. So it's just an interesting.
Yeah, in the context, sorry, I'll let Mag make his point because I interrupted him. But the last thing I'll say there is in this point about like I guess to tie it back to MEV and crypto and not sway too much to the Amazon part of it. Really, the important part here is to allow market makers to provide liquidity efficiently. And that's ultimately the driver that will make sure that none of these centralizing forces are able to accumulate and snowball into something that's pretty terrible.
I just wanted to say is sort of, my philosophy on these things is sort of like three big things that sort of go through my mind these days. One is we don't really know what the right solution is. Like we're all trying to figure it out and presenting sort of different ways of structuring the market. And ultimately, I think the worst thing we can do is be like, this is the way, right? Like, or PBS is the way, or, Suave is the way, or Skip is the way, whatever it is. Like, I think making sure that there's chance for exploration about how these markets work is really important at this stage, and sort of not stifling that, innovation. I think the second thing is there's also like a legal conversation around a lot of this stuff, right? That I don't think we got into here, but like, we recently talked to a lawyer and they're like, you might become a money transmitter, right? Or Flashbots might be a money transmitter. Like validators might be, I don't know, Xave, what are they saying you might be? Something scary?
Fortunately not. We try to avoid those types of conversations.
Okay, cool. Well, anyway, there's like there is some conversation about how these things work, and a far version of this might be that users are required to be given best execution, right? Which is how it works in traditional financial markets, and everybody sort of works around that sort of baseline. And then I think the third thing is like, I think MEV's history is not yet written in terms of how it relates to user experience. I actually think the most interesting things I've seen in MEV is how it affects like the basic user in terms of using their chain. There's like a good article written about this that I invite everyone to take a look at by Presswitch about like MEV wallet, or sort of like using MEV to like put yourself up to the top. But I think what we're going to see is like an explosion of sort of like understanding like the connection between sort of the user experience, whether that's refunds or free transactions or whatever else it is, or atomicity or prioritization, and then also MEV, sort of how those things fit, which I'm very excited to sort of like see a lot of solutions for.
Want to make a quick point here before we get too entrenched in this, though, which is on sort of the regulatory thing that Mag was talking about in terms of best execution. It is a very crypto thing for us to basically discuss, like, redistribution of MEV in a sense where a percentage of the atomic MEV goes to someone who is not the retail trader. Like the analogy in traditional equities markets would be Citadel gives you terrible execution and keeps some of that spread against the best market price. And it is, in my opinion, obviously not a lawyer, but incredibly unlikely that when the SEC comes to look at MEV and how these swaps are getting executed, that they'll be like, okay, cool, 80% goes back to the user. No, they're going to, hand on table, slam their fist down and say 100% needs to go back to retail. So yeah, it's super weird. Crypto is crazy.
Yeah, maybe the conclusion is Gary is coming for us all, so we best all be careful, guys. Yeah. Guys, this has been a super fun hour. You've given Miles and I a lot to digest from this conversation. If folks want to find out more about each of you, follow you on Twitter, follow your projects, and keep up with the good work that you're doing, what's the best way to do that for all of you? I'm not going to call whoever's feeling bravest here. You get call it out.
Okay, I'll kick off. dflow.net is our website, and @dflowprotocol is our Twitter. You can also follow me at Nitesh Nath is my name, and usually post MEV type stuff there too.
Yeah, and I'm 0xave on Twitter, and chorus1 is the website, and the Twitter is just chorus1 with no spaces or anything in between, no dots.
I'm at OXMagmar. Used to be a Pokemon streamer, so that's from leftover days. And then the company is at Skip Protocol, and our site is skip.money.
Wow, that's awesome, Mag. We definitely need a couple of minutes to dig into that, but we'll save that for the next time we do a pod together. Guys, it's been a super fun one. You've been super generous with your time, so Thanks a lot. This was great.
Thanks so much,
Take
guys.
care.
All right, partner. Great podcast. What do you think?
Yeah, it was a lot of fun. I thought, it was great to have this conversation with folks across, different parts of the MEV value chain. We have Nitesh, who's really building kind of for wallets and really focusing on order flow. And then you have Skip that is building all sorts of block building software and solutions, both on-chain solutions and off-chain solutions for app chains. Then you have Course One, who is at the validator level and participates, actively across general purpose L1s, app chains. And so they can see the full spectrum of approaches, to MEV that are being pursued here. And they can have a great perspective on kind of the trade-offs that we're trying to tease out.
Yeah. Yeah, absolutely. I think one of the challenges of this discussion, you kind of kept hearing it from Maghnus, is like, hey, we are venturing into new ground, new territory here. Hey, we're breaking new ground. Like a lot of part of the reason it's exciting to be talking about this now is it's happening, but also necessarily there are a lot of the sort of big ideas that I think you and I want answered sort of still sit in the realm of conjecture. So just kind of bears mentioning, right? That this stuff.
No, it's very similar to like a lot of our other conversations. We're talking about, what sort of stacks work best, right? We've only seen the Cosmos full stack, in action. We've only seen Ethereum and Solana in action. Same with MEV. We've only seen really off-chain PBS solutions in action at scale. And that happens on Ethereum and Solana to some extent. And we're only now beginning to see really what full stack app chains can do with say, Osmosis kind of leading the way in partnership with Skip. And there's still so much that, we spoke about today, but has not even, development is in the first inning, right? Much less, there's no usage of it yet even. It's not developed. So
I thought it was pretty interesting to get Xave's perspective as a validator, right? Talking about where value accrues, and he kind of did it chronologically, which I've never heard it broken out. But like first, there were only miners, right? So all the value sort of accrued to them. Then there were the searchers, and then the builders, kind of the relay, and so as each new kind of component cropped up, obviously there was less competition in the beginning, so an enormous amount of the rewards sort of flowed to them. It's just interesting to hear is almost like a whack-a-mole type description. And then obviously wallets haven't really had an enormous amount of success yet, but there was a big question mark there. And I think everyone, once we posed that question, had done a lot of thinking about that. It also is interesting to hear him say that all the validators, something they always ask is how can we differentiate? And I actually have to, not that this is necessarily the case, but it sort of rung a little PTSD bell for me coming from the world of consulting, and a bunch of our friends are in like investment banking. I'll tell you something that investment bankers all ask, like, how do we differentiate? What's our value add? And usually when you have to start asking like what the value add is, it's not quite as obvious, not to say that, Course One is phenomenal and like on the cutting edge of all this stuff, but it was interesting certainly to hear that dynamic voice.
Right. I mean, everybody, all validators are providing, somewhat of a commoditized service in terms of securing the network and validating blocks. And so it's more about what else can you do for the network that makes you more valuable for your delegates and will attract more delegates, right? And I think part of what he said that was also interesting too is really just the difference in communities and what communities care about. Because I think, for app chains, you're just dealing with a smaller community, right? That is only cared about, really prioritizes their own application and the user experience for that specific application. And so they can be, much more opinionated, naturally more opinionated than say a general purpose chain that is trying to appease a community of thousands of apps and millions of users that all have different, priorities and interests. And so there's the technical components of what is possible and not possible of, with an app chain and a general purpose blockchain. But then there's also kind of the social components of just how far an app chain is willing to go in order to exert, control and influence over these questions versus how far the community that is trying to appease as many builders as possible will go, right? Because as soon as they start prioritizing one application or one, sector of applications, then they've got all the other parties and stakeholders, start to get upset, and that potentially leads them to move to their own environments, which decreases the value of all the MEV being generated on that general purpose L1. So just MEV is so interesting because it does really intersect, between technical and social. And there's, a lot more to dig into here, but I thought that was interesting.
Yeah, me too. And, I think we're a little biased here, I think, because we had the perspective of three people who spend a lot of their time in the Cosmos ecosystem, obviously. But it did sound like just the nature of the, many different layer ones, right, kind of makes it a little bit more complicated, especially when it comes to this sort of cross-chain MEV domain, right? There's definitely, like I think Maghnus said it best, like in theory, it sounds great, right? Like when you're reading the Atom 2.0 white paper, you're like, yes, huge value, totally see it. This makes all the sense in the world. But then when you get down in the weeds, like, ooh, this is actually a very difficult, bordering on impossible problem.
Yeah, right. But, they're building at the forefront, right? We know what we're trying to solve for, right, in those objectives. And we're trying to find solutions that solve for as many of those as possible. And unlock new use cases potentially as well.
Something that I wish we got into it right at the end, but I would love to have gotten more of their thoughts on, this is less of a technical, but more of a philosophical discussion about like what constitutes good versus bad MEV. And usually when that subject gets brought up, people are like, oh yeah, well, sandwich attacks and front running are bad and back running is good. But the reality is there's an enormous long tail, right, of other forms of MEV that exist out there that much more fall in kind of like a nuanced gray area. So I think I would have loved to get a little bit deeper into the weeds about like what constitutes good and bad MEV.
Yeah, I think that's fair. And but it's also worth mentioning that long tail is really only of material value on general purpose chains. Because, part of why you can have a solution that is so opinionated and customized for an app chain is because there is a pretty narrow design space for MEV that's possible. We used Osmosis as an example, but I'd say, 95% of MEV generated on Osmosis is, from potential back running or front running of swaps, right? It's a DEX, versus, Solana, which has an enormous long tail. And so, I think the difference there is from a practical standpoint is that Osmosis can build things like the ProtoRev module that is basically a protocol owned arbot, right? That is run on every validator and is capturing that, lion's share of all MEV generated. Where, if you were to try to build something like that on Solana, there would be days or blocks, right, where it's looking for what it thinks is, the most common forms of MEV, but it's leaving enormous amounts of value on the table because there's no way it can possibly, cover all the different sorts of long tail opportunities. And so I think that's what I thought was interesting about Course One's paper last week is that it's implying that there should be kind of, a marketplace of searcher, strategies that validators can pick up and then potentially kick back a revenue share to those searchers. And that would allow the validators to run some of these systems, in protocol, but also be able to capture the longer tail of MEV and distribute it, to the searchers that generate it, basically.
What did you think about Nitesh's point at the end where he's like, it's all well and good, so that we can say, hey, like, we'll have horrible execution, but we're going to kick back like 80% of this to users and that'll be fine. And the SEC coming in saying, hey guys, we actually have rules out there about best execution, giving best execution to retail. And you can't just have bad execution and kick back 80% and call it a day. What was I know that's kind of a far off question, but like, what was your sort of thought on that?
Yeah, no, I thought that was interesting, along with his point around really, how we're going to, there will be at some point a separation of MEV between execution auctions and block space auctions, because those two things can potentially fill very different needs. And I think it's unclear how this is all going to play out in terms of whether kicking back, say 80, only letting the user capture 80% versus kicking back some sort of revenue share with other providers, whether or not that will fly or not. But I do think that the point that's really interesting is that you, by separating execution from block space auctions, you could offer some pretty significant benefits to the users in terms of getting your trades done basically immediately and guaranteed at the very best price. And to me, it raises some questions around, okay, if that's all being controlled basically at the wallet level, is there a way for apps to also, see some of that value as well? Maybe it's an app specific wallet that, becomes available long after account abstraction is implemented. So folks, users are not creating new seed phrase for every app specific wallet they use, but it would, potentially allow something like that, would present a different future than, say, 5 wallet providers or even fewer wallet providers really dominating the whole space.
Mm-hmm. Yeah, it's tough. It's once you kind of have there's a specific phrase for this bias, but like once you've seen a problem solved in a specific way, it's very hard to unbox yourself from that problem. And I have to admit, I've been sort of red pilled on this. The analogy that Sunny gave us in the beginning of this series, which was how this sort of played out in Web 2 and the power that apps at the very that have close proximity to the consumer or the user, the amount, like the natural tendency, the market force tendency for centralization. And, when I think about it in my heart of hearts, I'm like, okay, there, like, what do I think is most likely to play out here, right? Like there might be these other solutions where apps want to control the wallet, right? And there's a beautiful full stack sort of synchronous there. But in reality, like someone, right, is going to start a wallet that's like pretty good. They're going to be phenomenal at distribution and marketing. They're going to grow that baby. And that, like, as soon as you have that like critical mass of users, which you can argue MetaMask is like close to having right now, but in the grand scheme of apps, it's still very early days, very few users. And I just see that natural convenience being a huge factor. But the little voice in the back of my head is saying that's a very kind of Web 2 paradigm, and who's to say it will play out like that again?
Yeah, it's true. And I think we talked about this a little bit, but is the user relationship with the wallet, or is it with the application? And I think there's probably strong arguments with both, but my hunch is that it's more with the application that really has the brand and has been the reason you're a user of a blockchain application in the first place is because they're providing some service that you want, and the wallet's just the middleman in between there. But yeah, I think it does definitely pose some big questions, because even something like DFlow, like basically an execution environment, is competitive with a lot of these applications that we're talking about, like DEXs. And so maybe, DEXs become a thing of the past, and all of this is handled at the wallet level with these different, probably order flow routing solutions. I think that's probably a little extreme. But yeah, it's definitely really interesting points raised that I hadn't thought about too much before this conversation.
And by the way, it's kind of played out differently in there are two different models, right? Like there's a great paper from Z Prime Capital that kind of used the fappening example, and the what they're using as an analogy or inspiration is like kind of the super apps that exist in China, right? But that doesn't really exist in the United States. There are in like kind of there are lots of different small apps, right? There are some big ones like Amazon is huge, but there's also, there's not one interface where you call Uber and Airbnb and et cetera. You have a relationship with each one of those apps, where in China it'd be one super app that you do everything from. So I don't think it's destiny, right? That it plays out in one specific way. I don't know.
Yeah, exactly. And maybe just for the audience, the fappening refers to the flippening of value from the L1 base layers to more value being accrued at the application layer.
Damn it, Miles, it probably is good to provide that as a disclaimer.
Yeah. So really,
we'll link it in the show notes. It's actually it's a great read.
And yeah, exactly. It is. And what that gets into is these apps that, start with one service and capture users and then eventually expand horizontally into lots of different services so that the user basically has one interface for anything they could want, or maybe anything they could want within a certain sector. And then the question is, do they expand vertically up into the wallets? Do they expand down into their own, app specific rollup or chain? And what is the sequence of that? Because it does, again, my hunch is that they will, once you hit critical mass, you will want to expand, one way or the other, in order to capture more value and offer an even more, differentiated product experience for your users.
Yeah, you bet. All right, buddy. I think that's all the time we have here, but this was a fun one. We'll see you same time next week, partner.
Sounds good.